Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveny. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome, everybody, to another episode of Created Wealth Simplified podcast, where we teach investors how to create wealth through alternative investments. Today, we have a special guest. We have Michael Episcope with Origin Investments. Michael, how are you today?
Great. Thank you for having me, Chris.
Thanks for being on this Monday. We were just talking before the show about how Michael, who's in the Chicago area, was sending us in the Washington, D.C. area some little nice warm weather, which it is in the 60s. And when I had a chat with my team out in California today, they were dressed in like thick coats. So it probably was only 70 there for them, which is cold. But today, we want to talk about multifamily, and Michael, who is with Origin, has done over $2 billion in real estate transactions. Like I mentioned, they're based in the Chicago area. Him and his partner since 2007 have managed more than 5,000 multifamily units. They are across the Sun Belt. There's a very long list of things Michael has accomplished in his career, and he's going to continue to grow it. But today, we're going to talk about where Michael is today, how he got there, and share a lot of insights for what people can expect in the next 12 to 24 months in investing in real estate, because I think there's going to be a lot people are going to have to pay attention to. Would you agree, Michael?
I agree. That's a lot to pack in 30, 40 minutes, but I'll do my best.
So why don't you tell us what Origin is your primary focus today? What are you working on?
We are a real estate investment manager located in Chicago. We invest in multifamily in Sun Belt states. So we are in Charlotte, Raleigh, Atlanta, Florida, Tennessee, Texas markets, and then west, we're in Denver and Phoenix. And we build, buy, and lend to multifamily properties. So we really have three strategies under our house. We have 4 funds that are operating today, and we represent about 3,200 investment partners, and they're high net worth, ultra high net worth family offices, and our own capital as well. So we've been at this for 15 years now. We have 50 people at the firm. I'm in Chicago, but we actually do not invest here just because headline risk, fiscal situation, the crime, things of that nature. And when you have sort of a view of the world and you can invest anywhere, you're looking at cities that have the highest population, job growth, good demographics, low taxes, lifestyle cities. That's tend to be the places where we want to put investment capital.
So you mentioned something that just jumped right in my head. You've been in the business since about 15 years, and I believe, and you've got 3,200 investors right now. And I'm guessing those are all accredited investors. How did you grow, or what was one of the major importance of how did you get that many investors? I guess is really the question. That's a lot.
I'll take it back to the beginning because my partner and I formed the company in 2007. I came out of the commodity trading business. I was an interest rate trader and had amassed a meaningful amount of wealth. I retired from that business. I went back and got a master's in real estate. I knew I wanted to do something in the industry. I wasn't sure yet. Mm-hmm. And he and I had done a lot of passive investing together in 02, 03, 04, right up until that point. It always felt like 1 step forward, 2 steps forward, 1 or 2 steps back, and we weren't really getting ahead. And we wanted to use real estate to protect our wealth, to grow our wealth, to turn our assets into income. And we literally I think it was in about 06, we came to the same conclusion. Like, if this is the best the market has to offer, we can do something better. And we pooled our own money together, got together and thought about where we wanted to invest it. At that time, it was more credit. Cracks were showing in 07 in the market. And we just started investing. And it was really in 08, 09, that period, we started to bring in outsiders, close family, friends, people in our network, and we found great deals. And we just started building from there. Our first fund we launched in 2011. It was a value-added fund. We were more on the equity side there. You could buy deals at, kind of feels crazy today, but 50% high-quality deals below replacement cost. And that was sort of how we started. And The inflection point, though, for us, for about the first 6 or 7 years, it was all my partner and I, word of mouth, our network, people coming in, and we were doing fine, but we were growing our personnel, we were growing our business, and we wanted to grow faster. And in 2015, we just said, look, we really want to grow and we have a great product. And the idea is if we get it in front of a lot of people, we'll get more investors. And that was at an early time in our lifestyle. And sort of the Jobs Act had passed in 2008, which really allowed companies like ours to market. But it was very controversial even then. There were only a couple of companies doing it. And we decided to embrace it with that simple philosophy. If you have a great product and you put it in front of a lot of people, you're going to get more customers. And that was in 2015. So it took us the first 7 years to get about, I would say, 90 investors. And then the next 2 years, we ramped that up to about 550. Now, the difference was it was working and we knew that, but we only had one product. We had our Fund 3. It was a value add product at that time. And we sort of sat there with 550 investors for the next 2 years as we planned what was next for Origin, our product mix and everything. We came out with our Income Plus Fund, which is a multi-strategy, open-ended fund in 2018, 2019, very tax efficient. It utilizes all three strategies, the build, the buy, and the lend into a single product. We also launched a QOZ fund, a Qualified Opportunity Zone fund at that time. This past year, about a year ago, we launched our Multifamily Credit Fund. And then we've also recently launched about 6 months ago, what we call our Growth Fund. The Growth Fund is 100% ground up development. When you think about it from an investor standpoint, we span the risk reward spectrum. So the Multifamily Credit Fund for lower risk investors who are looking for yield. Income Plus Fund is for moderate risk investors looking for yield and appreciation. The Growth Fund for all ground up development is for higher risk investors looking for only appreciation who don't really have a need for yield at this time. And I should say everything we do is through the lens of the high net worth investor, the ultra high net worth investor. We are still the largest investors at Origin. We're a top decile manager. We've beaten over the years, our 8 funds combined have outperformed 90% of the market. We're very proud of the team we built, the track record, everything, and sort of where we sit today with the suite of products. There's something for everybody there, depending on your risk.
Quick question. All these funds, I'm guessing, are they through the Regulation D 506C offerings?
506C, exactly.
Yep.
Yes,
Okay.
for accredited investors, except for the Multifamily Credit Fund, because the Multifamily Credit Fund invests in K-series bonds, which are issued by Freddie Mac. Okay. So those are considered securities, and those are for qualified purchasers only. So investors in that particular fund have to have a net worth of more than $5 million or investable assets above $5 million. And the minimum in that fund are a little bit higher, $250,000 in that fund. For the other ones, it's $50,000 to $100,000 for the accredited investor.
So when you kind of peel back the onion a little bit, you said you went from about 90 investors up to 500 because you had your one product. What was that product at the time? And what was the differentiator from that product compared to maybe other products that were on the market or in that area?
That was our Fund 3. It was a value add product. I don't want to give you the impression that we just decided to throw some marketing out there. This was a long process. We rebranded the firm. We brought in technology. We started investing in marketing, which we had never done before. Prior to that, it was my partner and I running out, having lunches, having dinners, meeting people the old style way. We invested in investor relations, and we really set up a lead generation machine to be able to do that. And our previous 2 funds had both performed in the top decile. They were also value-added funds, and that's what Fund 3 was. Fund 3 was a $150 million value-added fund focusing on multifamily primarily, and then we had some office in there as well. Today, we only do multifamily. We've gotten rid of the office. Those were our last office investments. And I think it was a combination of both our alignment within our organization, the transparency that we're showing. We did a lot on the content side. We feel incredibly passionate about improving this industry, making it better, educating our investors. And that has brought a lot of people to us, and then our team. And so when you sort of have this trilogy, whatever, this trifecta, when you've got alignment and you've got a track record and you've got a great team, and I'm going to just throw in there all the transparency and the fees and stuff that investors look for, I'm not going to call it an easy sale, but it's our job is to educate investors about the market and what we're doing. And their job is to make an educated decision on what they're buying. And that's how we've always looked at it. We don't call it a sale because we're not paying anybody to sell our products. We don't use the broker dealer market. We do invest with a lot of RIAs, registered investment advisors, but they actually get paid by their client. We don't pay them to distribute our product. We've always believed in being direct to consumer and that a great product is bought, it's not sold.
I'm going to joke a little bit right now because prior we did not pay you to say any of that. And I joke because that's kind of what we've been talking about on some prior episodes was for the last 5 or 6 years, we stayed smaller in size and stuff. And we're working on many things to scale. We rebranded, brought on what was myself. Then I brought on a few people. And then we're a team of 10 now, and we've expanded. And again, you do that, do the marketing. And since we launched our Regulation A+ offering over the last end of July, we have more investors now over the last 3 months than I did the prior 5 years, just by putting in a plan and start doing marketing and really focus on marketing, because that's one thing that I think as a real estate investors, I think it's hard because a lot of real estate people, there's nuts and bolts and numbers guys, and marketing is something different. Again, there's analytics behind it, but you're looking at, well, do I want to spend this much money on marketing where I can put in a deal, or you're trying to look at your IRR and trying to maximize returns. So marketing is something that needs to happen, and it takes time. And like you said, it goes back to, you have to build a brand and have that reputation. You can't just pop up out of the blue and say, oh, I'm going to do this.
Yeah. And I think the Jobs Act was one of the best things that ever happened to the real estate market, because if you think about the laws, they go all the way back to the Great Depression, which were supposed to protect investors. But the idea was that if you're accredited and you have money, then you're a sophisticated investor and you know what you're doing. But really what's happened with the Jobs Act is it's made the market so incredibly transparent and opened it up to the crowd to do due diligence that if you don't have a great product, then you can't survive in this market. I'll tell you, like my partner and I had a lunch. This goes back about 1.5 years ago. I wouldn't call them a competitor, somebody who's in the market. And they just said, hey, we love what you're doing and we want to do it. And we literally just said, it won't work for you. You don't have a good product. You're still engaging as if it's the 1980s and you're taking 5% fees up front. Said, look, if you want to change your whole business model, you can go into this world. Well, guess what? They did. They decided not to do it and just stay where they were and continue to ride out with their existing investors who didn't ask questions and who don't ask questions. And I do believe that the Jobs Act has really been one of the greatest pieces of legislation to ever hit the market for investors.
And especially in today's world where if you're on any coast, it's pretty high chance you're probably an accredited investor. Because in Washington, D.C. or in California, I mean, I think in California, they pay the lifeguards like $175,000 a year. So it doesn't take, in certain locations, it's not hard to become quote unquote accredited. If you didn't have that, where would you be stuck today? Well, guess what? I'd be stuck in the markets and I'd be watching whatever investments I have. Basically, and again, over the last 5 years, markets have done great, but you'd have no other options to shift things or move things around to other alternative investments. So I agree wholeheartedly, the Jobs Act, that it did come out and really open up a lot for investors to be able to create these offerings to give people the ability to invest. And like you said, it's the war of attrition where if you're good at what you do, you'll survive. But if you're not, there's a lot of people involved, you are not going to survive. So
very true.
Let's talk a little bit about forward looking on things, because we talked about kind of you set up your business, and I love the approach how you've kind of cover every basis of for investors, and you give investors the options basically of here's the menu basically on risk reward component. And that's something we used to do in the past with some of our funds. But looking forward now over the next 12, 24, 36 months, what are some of the things that as a business owner you're looking at right now, or some of the things that you're monitoring or paying attention to? And if you made any shifts in the way you operate your business?
Yeah, I'll unpack that a little bit. I mean, right now, the biggest thing we have to worry about is higher interest rates, capital markets, valuations, things of that nature. And you had brought up our funds. One of the things we have to be as investors is agile and be able to work across the spectrum. Because I think with a lot of companies out there, they make the mistake of having some one mega fund where they can only do X, Y, or Z, and that's all they do. And they paint themselves into a corner. And candidly, you saw this a lot in the last, I would say, 6 months to a year and a half, where these funds were bringing in so much money and they were value add funds. So they could only buy existing. They couldn't decide to do ground up development. They couldn't do pref equity. They couldn't position themselves differently. And they were just buying at any price. It didn't matter. And that's always been important to us because it's our money also going into these funds as well. So your question was about where do we see the opportunity today? It's in the credit side, 100%. The markets are fragile right now. We don't know where valuations are. We know that they're lower. A year ago, cap rates in the multifamily sector, the institutional side, which we operate on, were about 3.5, in some cases 3.25. If you bought in early 2021, you're probably fine because you had a considerable amount of rent growth. If you bought in the middle of 21, you're probably not doing so great. And if you bought at the end of 22 or the end of 21, early 22, you bought the top. And those investors are going to really suffer. What we're seeing, though, especially in our multifamily credit fund, I alluded to this earlier, we buy K-series bonds. And the first thing to react in any market are the public markets, things that are liquid, things that people can actually liquidate to raise capital. And that's where we are seeing. So the K-series, they trade in a private market, but they're liquid securities. And we've just seen a lot of disruption on that side to the point where we're able to generate 12, 13, 14% yields on really, really safe collateral. I'll take basically what a K-series bond is for borrowers like us, when we go out and buy a multifamily property for $80 million and we leverage it to 65% and we use Freddie as a government agency subsidized loan, we borrow from them at 65% and they take that loan and they pool it with 100 other borrowers and they put it into a package and then they securitize them and they take off an A note and a B note. And the K-series bonds that we're buying are the B note. So when you think about within a K-series bond structure, the A note is guaranteed. It's basically 0 to 58% of the entire capital structure. And then where we operate is that 58 to 65. In a market for us to get hurt, the property has to lose that equity first, that 35% of value before our first dollar is even at risk. So to be in that position, to be earning 12, 13, 14% feels really, really good, especially with institutional quality borrowers. Because the thing about Freddie, if you want to be in the multifamily sector for a long, long time, you can't default on bonds because they will just not lend to you. And one of the greatest things about being in multifamily real estate, especially on the institutional side, is government agency, is our subsidized loans by companies like this. And so over the history of this, 25 years going back, the worst vintage was in 2006, and that bond lost 0.42%. 0.42%. There have literally been no losses over the last 25 years because of how well collateralized these bonds are. We love them. I love them. This is where I'm investing my own personal money. The other place where I see coming down a lot is in the private real estate side. I'll call it gap equity, preferred equity. We're starting to see a lot of these projects that are being completed go out to market for refinancing. And historically, when you were maybe taking out 30, 40, 50, maybe even 70% sometimes of your equity, a lot of these companies now, they have to write a check to the bank upon refinancing because they're just not meeting the loan to value, the debt service coverage ratios. Banks are becoming much more conservative. So gap equity, preferred equity, that is going to be a huge opportunity for the next, I would call it 6 to 12 months. And that we are taking advantage of in our income plus fund on that side. So credit is where you need to be positioned today. I think going down the line, we could see distress. Generally, this isn't '08. We still have a housing shortage. We need 4 million units in this country built. The majority of those need to be built in sort of those Sunbelt states. And in many ways, this is a welcome pause because we have seen construction costs go up. We have seen projects, just these labor, these construction workers naming their price, that now that people are pencils down and there's a balance back to the market where you're starting to see construction costs slow down, get better pricing out there if you're doing deals. But for a firm like ours, on anything on the equity side, especially ground up development, it's pencils down.
Yeah, the ground up, and we're in the Washington, D.C. area for the last few years. Very good example there if pencils went down, because if you mentioned prior to the interest rate spike, the construction costs and typical rents in and around DC prior to COVID were somewhere in the outskirts around $3 a square foot is what they get for rent. But the construction, which you could make a project work at that point in time, depending on how much parking and below grade you had, because that's where you could end up losing a lot of money because there's not a lot of ground where we are. But you could still make them work. But then once construction costs just started going up 20, 25%, numbers just didn't work. And even though the rents did continue to rise, numbers still didn't work. And then when you factor in today's environment, the lead time issues on materials, the contractors themselves are still super busy. They're still very busy. So to get them on a schedule, to continue to get a job, to get into a flow and complete it on time. I mean, jobs right now, a typical in our market, about 18-story multifamily building, which typically would have taken about 24 plus months of finish, is now over 30 months. And when you think of 6 months of hold time, the absorption taking that much longer on the apartments, it's not economical. So like you mentioned, it's the housing component of, I don't think we'll see a 2008 because we don't have that housing. And today, in the last few years, there hasn't been that humongous uptick in people just throwing homes up everywhere. Would you agree?
100%. I think the Fed's going to do their job. They're going to continue to tighten until they send us into a recession. And one thing that there's never been a recession without the 10-year note coming down by at least 150 basis points, and that would put it back under 3%. But even to simplify it more, I would say you don't buy real estate so you can write a check to the bank every month. The numbers don't work today. Even if you were able to buy a 4.5 cap, you might feel great about it unless you're unlevered because financing costs are 5.5. And imagine if you bought a 3.5 and now you're in floating rate debt, you're writing a check to the bank every single month. That math doesn't work. And until things come back into equilibrium where you can make 5, 6, 7% on your money in an equity position on a cash on cash, the market is going to be stalled for quite a while. And we're going to have to see financing rates come down. We're going to have to see values come down and probably a combination of both to get back in line to historical norms.
So a lot of our listeners are accredited investors, and they, of course, look at many different syndications and things to look for. One of the things I've mentioned in the past, and like I've been wrong many times, but I've seen a lot of syndications that are, I'll say one property, the single property syndication where they're going to raise 40 million to buy some apartment building. And they've been buying it, of course, and like you mentioned, last 12, 15 months. When you see those types of syndications coming down the pipe where it's really just to acquire one asset, would you, especially where things are at right now, consider that very high risk because of potential limited exit strategies?
A single asset is always riskier than a fund because of the lack of diversification. I think it depends on the asset itself, on the manager. We don't do syndications on single assets for a lot of reasons. And one of them is that we actually did a few syndications years ago. We did it on an office deal. And so that office deal became the bank of Michael and David because we kept losing tenancy. And an office is very different than multifamily in terms of the cost to operate it. But what happened is that we didn't want to call money from investors, right? And when things go wrong, what happens to the manager? They generally lean on the balance sheet of the investor. So if suddenly that $40 million disappears or comes to 20 and the bank calls, well, then your limited liability company, who are they going to call, right? Okay, we can give it back, or we're going to make another capital call, and those who invest will dilute other investors. And there's a huge advantage to running a fund because it's more like a company, and we can take money when we refinance one asset, give it to another, things of that nature. But there's so many nuances behind it. Sometimes a single asset can be an absolutely great investment at the right moment in time. I would tell you today, it's probably something to stay away from on the equity side. We just don't have enough price transparency out there. And the bid ask, nobody really knows where the market is trading today because no trades have taken place since the 10-year has hit 4.25, 4.3%. And we need price discovery. But to go back and look at 3 months, 6 months ago and say, hey, we're going to do this deal because look at the comps that traded 4 months ago. Well, I can tell you the comps that traded 4 months ago were deals that were under contract for 3 months. And the only reason they traded was because of inertia, not because some smart guy did it. So you have to use a little bit of vision in this market and understand that anything trailing and looking behind you is just a waste of time right now and looking at that stuff. There will be some pain ahead. So just tread lightly on the equity side.
That brings up a point too. Like for us, I mentioned prior, we buy a lot of distressed debt, and the basis of our pricing model is based off the balance of the loan plus the actual value of the property. In many instances, there could be still, believe it or not, there's still borrowers that could be underwater a little bit or close near that equity. And trades that happened 3 to 6 months ago, it's the same thing in our business. You can't base anything off of what traded 3 to 6 months ago because I think a lot more people have more understanding of where things are headed. And again, I'm not predicting any type of crash, but 6-8 months ago, people thought home prices would stabilize or continue to grow. Now, if you ask, I think anybody in real estate we're talking kind of single family right now, except for potentially certain markets, but more broadly based, and we're already starting to see it, you're seeing softening in pricing. And if you have to go back and take that property back in 15 months from now, you're trying to guess what that value is in 15 months. And you got sellers saying, hey, I think the value is going to be the same or higher. When reality is, as an investor, if I was playing the odds, I'd bet against that being the case of a property value being worth the same or more in the next 15 months. I'm going to bet on it being less. And that's where I think if you ask anybody, that's probably what their thought process is.
I think you're right. Over the next 15 months, we spend a lot of time, effort, and money on something we have internally called Origin Multilytics. It's a predictive tool for rent growth, and it works at the city level. It works all the way at the property level. It's incredibly accurate. And we decided to build it a few years ago because what we could rent out there just seemed inferior and it was wrong. And so we hired 2 University of Chicago data scientists to build this. And basically what that's showing today is that we are going to see a softening of rent over the remainder of this year, negative rent growth in 2023, and then sort of an upward resumption in 2024 into 2025. So I think if you're delivering next year or even early into 2024, you're going to definitely see a huge softening in prices. And then we're going to see resumption. So over a 5-year period, you're still seeing positive rent growth. But over the short term, the next 18 months, there could be some pain involved. And that's when banks will start calling for more equity, that these projects that are delivering at that time will have a need for a gap equity. I think the fundamentals are strong over the long run, but like everything, we're going through a business cycle and you don't have to be a visionary to know that things are slowing down. And prior to jumping on this, I was talking to a reporter from Bloomberg, and we just talked about this exact thing. What's happening? I said, to me, it feels like it's about a 1-2 punch. First, the capital markets. We've seen interest rates rise. The Fed's going to do their job. They're going to put the brakes on. And then the second punch is going to be the operational revenue is going to start to slow down because the demographic within multifamily, one thing we've been enjoying for the last several years is the millennials who are just gobbling up rentals. Well, millennials are now getting to the point where they want to buy houses. And if rates come down, you can be sure that a big portion of these, what we call trapped renters today, people who would buy but can't, are going to rush to buy homes. And we're going to see a softening in that side. And that's another reason why, from an operational perspective, we've seen things hold up quite well in the last year because nobody can afford to buy a home. They are trapped renting, and you have more renters coming in behind them. So it's been a great couple of years, but the next couple of years will probably give some back, but certainly not all.
Yeah, I wouldn't imagine. And it's interesting your point about that millennials, because it go back in time 20 years when I bought my first house. And I bought my first house in 2001 and I was in my mid 20s. And at that point in time, it was almost like the fear of missing out because rates, I think, were, 7 or 8, and they kept ticking down, and they hit 6. And I remember my parents telling me, oh my God, if you can get a house at 6%, jump on it. Everyone should be buying houses at 6%. And again, 20 years ago, that was a great rate. And I think fast forward to today, where again, everyone has very short-term memory and selective memory, where now that, God, my credit union, I think is above 7% right now. And I think all of a sudden, if things start going back down to 5% or even below 5%, I think some people might get that little FOMO component of now I can afford a house. Oh, let me jump on it because I realize that is still, long-term wise, you can borrow money, especially either primary or for an investment property. If you can borrow money at 4 to 5%, to me, that's a steal. And if you look at any other country in the world, why is real estate so valuable in the US? Because we're the only countries that you can borrow money so cheaply and for such a long period of time, so
subsidized debt. That's what drives the market.
And you know better than me, but it really boils down to people typically get themselves in trouble because they over leverage, and that's, I think, the biggest thing and like you mentioned in those case series, you go up to about 65%, and that's always been the sweet spot from my days of working for a multifamily developer. And that's what they would do is it was a family owned business through generations. So they would typically put 40% equity just to even put a little more equity in the deal so they didn't have to worry about it at that point in time. So
yeah, you get better rates, you get non-recourse financing. That's one of the holy grails. And real estate, not only your tax advantages, the depreciation, but non-recourse financing and multifamily is fantastic.
One thing I wanted to jump back on as we start to wrap up the episode in the next 5-10 minutes was you mentioned with your investors and transparency. And that's something you hear a lot of people talk about, but I'm curious, sometimes I ask people, how do you define transparency? They just say, well, we're transparent. What is your process for reaching out to your investors, whether it's through webinars or mailings? Curious, what do you provide to your investors as part of the process to keep them informed on everything that's going on?
Yeah, I'll say informed. I hate the word transparency. I think it's overused. You're exactly right. And a lot of people use it. And we did a study when we were rebranding the company back in 2015 and went out and to different financial service companies. And there were 3 words, and I want to throw up when I see them on these different websites. It was client service, transparency, being honest. Yeah, I mean, you can name it. They were all cliche. Yeah. And we were just like, okay, we're going to make the decision. You will not find any of those words on our website anywhere. We believe in showing, not telling. So everything we have, when it comes to a fund, when it comes to fees, when it comes to all those things that the investors want to see, it's up front and center. We don't hide things. We don't put things on page 17. And I'll never forget, this goes all the way back to 2016 when we were first entering into the market. You get attorneys, you get all kinds of people who invest with you. And somebody in our investor relations department at that time said to me, he said, you know what I love about my job? There's no gotcha moments. There's nothing in the PPM on page 30, page 40, page 50 that, oh, I found it. And everybody's looking for that. And you just can't give them, because when you're trying to build trust online and with people, you can't give them any ammunition to find things that they can use against you. And so for us, it's always about, if this is a term that we believe in and we can justify, let's put it on the front page. Let's put it right up there. The other thing we do, over communicate. We talk to our investors constantly via webinars, fund updates, blogs, everything we can do, because when it comes to money, people are nervous, and we take our job very seriously about being stewards of their money. If they have questions, we will either answer it directly through a direct outreach, talking to them, or through a blog if we think that it needs to be more widely distributed, or through our webinar, which we leave pretty much the last 20 minutes for an open Q&A session where people type in their answers and we answer all of them. And to me, that's about showing transparency and being transparent rather than saying it on our website. If you find it on our website, I'll give you $1,000.
Quick question then, in regards to everything just said, I'm curious with the providing the information, the webinars, because right now people are more nervous, I think is kind of, have you had to provide additional information or change the timing of maybe if you did it once a quarter, are you doing it once a month? Or I'm just curious, because of the lack of uncertainty in the markets, had to change your business model at all to be more informative because of what's going on in other markets?
100%. And so if I go back to COVID is really when we started communicating with people. And that was at a time when it was March of 2020. And I've been an investor for 30 years now and you just treat people how you'd want to be treated. And when you don't have the answers, but everybody's asking you for them, that you have to go out there and just say to people, look, I don't have the answers. And that's what we did in April of 2020. We have to have a webinar. And somebody said, well, what are you going to say? And I said, we're going to tell people we don't know what's going to happen here, but we've made some really good decisions. We're in the right markets. We were leveraged correctly. We didn't cross-collateralize debt. Our money's with your money. And that's what we said. And people really like that honesty of coming in and just saying, we don't know. We don't know if we're back in 2008 again. That's what it felt like. Nobody has ever experienced the global economy shutting down. Not in over 100 years. And the financial markets weren't sophisticated back then. And we had this huge Q&A for 40 minutes that people it really made them feel better. And so we were communicating every month for a while until the markets calmed down. And then we went to like every other month. And then we went to kind of 2.5 months. Well, right now, we're starting to see that people are nervous again. And we've literally a week ago, we just decided to reenact the once a month cadence. Even when it comes to valuations, right? People have questions about valuations, and even to the point where they're questioning the valuations. So that's my job to go out. I'm going to create a blog. I'm going to go through each and every one of our portfolios. We're going to talk about every one of the assets. We're going to stress test them. We're going to look at what happens with our AI forecasts. Give them the information so they see and know what I see and know. And that's all we can do. And they can make their own conclusions. But I think lack of information and lack of communication is one of the worst things that a manager can do in a time of crisis. Even if you don't know, you have to be honest and tell people you don't know what's going on, but you're doing everything in your power to make things better. What people don't want is a black box.
No, 100% there. I've seen it in some of the investments I've made where you'd want to reach out, you want to know status, what's going on with things, and you can never get anybody. And that's kind of the worst feeling you can have, because it's like, you always think the worst. I mean, we're humans always tend to lean towards, I think it's part of ingrained in us. You always think the worst of things. And when you're reaching out to somebody and you can't get an answer to them, and that's why I tell people, I'm like, if you don't know the answer, don't BS me. Just tell me, hey, look, I don't know, but I'm looking into it. Or we can't predict what is going to happen because we have to wait till this A, B, or C, or hey, let's check back in a month and maybe I'll have a better update for you. But at least give them that courtesy of letting them know, hey, I hear you. I understand your concern, but unfortunately, I just don't have an answer for you right now.
And it's so hard for people to deliver bad information, and you have to get good at it. We're all adults. We all understand that to get 15, 16% returns, we are taking risk, and no tree grows to the sky, especially every single day of every single month. So that's all we can do. We can control communication. We like to say we're obsessed about two things, and that's generating returns and client service. And those two things, if you're an investment manager, you need to focus on those two things and just telling people straight answers.
Great. Well, Michael, thank you for joining us today. If people wanted to learn more about Origin Investments, the company, or reach out, what's the best way for them to get some information and reach out?
Go to our website, origininvestments.com. We make it super easy for anybody to engage with us. You can download our decks. You can do research on us. You can connect with somebody from investor relations. And as always, if you want to contact me directly, you can do so as well. Michael at origininvestments.com.
Michael, thank you for joining us on this episode of Creating Wealth Simplified. Hope everyone enjoyed this episode. As always, make sure to leave us a review and subscribe to us on your favorite listening station, and check out the video episodes as well on YouTube. So thank you all. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.